right. Welcome to episode 17 of the More Doors podcast. Today we have a special guest. And honestly, we did a prep call for this, but I think we're just going to let the conversation go wherever it goes. We're really, really excited to have another amazing securities attorney on and talk about what he's seeing right now, which Matt and I just talked about off air, which I think is an incredibly interesting conversation around investor relations and some other things going on in the market. That was a mouthful, but we're going to get started right now. All right, welcome back to episode 17 of the More Doors podcast. I am your fill-in host, Brian Force. Nick is in Vegas being lame.
I don't know if being in Vegas is lame. I'd rather be in Vegas, but this podcast is important.
Yeah.
We do important things.
We're
so, Nick, we miss you, bro. Come back with some stories.
Yeah, and some gifts.
Yes. Not everything that happens in Vegas has to stay in Vegas, especially when you're going to bring us free shit back.
Yep. Fair enough.
Right?
That's a good premise.
And some stories.
I like it.
Cool.
All right. We're very, very, very excited to get moving forward today. We've got a great guest, but first, we got to give a shout out and the love to all the sponsors. Go check out deepbluere.com when you get a chance. That's the home of Deep Blue Capital. If you're looking to invest, build your wealth, your passive income pad, and achieve your financial goals, we can help over at Deep Blue Capital. Check us out, what kind of projects we've got going on, updates on what we're looking at, what we feel is going on in the marketplace, and how we can partner with you to help your wealth building journey. Check out deepbluere.com. And when you're done with that, move on over to torestudios.com, T-O-R-E studios.com. If you want to do really cool video content, a podcast, whatever it is, look all nice and shiny just like us, check out Tor Studios. That's where we shoot this show, and they can help you with all your video production needs. I feel like I'm flying through that way fast, but that's better.
It is better. It's crisper. And you know what? I think we've got to shout out the newsletter. I'm actually really impressed by the Deep Blue Capital newsletter, which is released every Monday, by the way, for those subscribers that we have out there.
Every Monday it comes out.
Every Monday, just organically.
Just go sign up on the website, deepbluere.com.
Yeah, we've got blogs and multifamily articles and updates. Well, we're having an investor update here, or not even an active investor update, just interested party update on an asset we acquired earlier this year. So good stuff. Go to the website, subscribe to the newsletter, keep in touch with us, follow us on LinkedIn and Facebook and Instagram now too, right? Yep. We're chopping it up, Opus style.
Opus style, exactly.
Hashtag best beard ever.
There you go.
Love you, Jesse.
Oh, man, I am super, super, super excited. Today, we have got Nic McGrue on. So Nic is a securities attorney. Man, heck of a background, Nic. He is a syndication securities attorney, like I said. Graduated from University of Washington, went to law school at Pepperdine. No, I'm sorry. Yes, he did. Nope, I'm sorry. He went to University of Caruso at Pepperdine. He is licensed in California, Washington. And forget the education aspect. Nic has helped his clients secure and raise and sell more than $2.5 billion in assets. So he has got the track record to back up his expertise, and we are massively excited to bring him on. He is also a tenured professor at El Camino in California right now. So he is on the front lines, not only of the educational aspect, but he is a practicing, very, 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 very experienced syndication and securities attorney. So we're going to learn a lot from him today.
Yeah.
So
he also plays the alto sax, which is a fun fact. And if we play our cards right, pun intended, he said he might do a card magic trick. I don't know about how I feel about an attorney that does magic tricks, but apparently Nic's one of them.
Yeah, attorneys that practice in illusions. Well, let's find out. Nic, welcome to the show, man. We're super excited to have you on.
Very happy to be here.
I appreciate it, man.
We got him laughing already.
Exactly.
Good. I like it. See, I told you, Nic, we do things a little different.
I love it.
Man. So, we read the bio, obviously, but we never do the justice that I like. So, first and foremost, thank you for being on here. We'd love to get, the 30-second elevator pitch on who is Nic McGrue. What do we need to know? What's important? Tell us a little bit more about yourself and your background.
Yeah, so I am the founder of Polymath Legal. At Polymath Legal, we help real estate investors lawfully raise capital so they can generate passive income while creating generational wealth. And so if you're looking for deals, needing the capital, if you've done that, you know that it's kind of difficult and very nuanced. So we help you navigate all those complex, nuanced laws regarding raising capital. And so we've had Polymath Legal. We just celebrated our 13th birthday a few weeks ago, and we're going strong and growing. And as you said, we are very heavy in the syndication, securities, and exempt securities world, and still going strong.
Love that,
Nice.
man. Congratulations on turning 13.
Absolutely. That's awesome. That's awesome.
Very cool, man.
My daughter's 11. So like he's been around longer than that. That's crazy, man. See, I'm good at math apparently.
So you went to school in Washington, based out of California. Now, is most of the work that you guys do on the West Coast as far as your syndications, or are you kind of all over the country?
Yeah, so most of our clients are dealing with federal exemptions, so those laws are going to be the same regardless of what state you're in. So some of our clients are located on the West Coast, but pretty much all of them are doing deals in the South and Southeast and kind of the Sun Belt areas.
Yeah, 100%. And just for our listeners and viewers, when you talk about federal exemptions, that kind of explain that to kind of break down for us what that expertise or that specialty kind of what that involves.
Yeah, so this is overly simplifying it, but in many cases, if there is a passive investor, so they're saying, hey, I'm going to give you money and I want to sit back and just collect more checks from you. I don't want to do any of the work. I don't want to be, fixing sinks and toilets or anything like that. I just want to invest and you give me a return on my investment. So in most cases, if you have a passive investor, then you're selling a security. Yep. And so the law says if you're selling a security, then you either need to register that security or have an exemption from registration. And so there are state-based exemptions. So each state has its own set of securities laws as well. But if you're following a federal exemption, so that's a national one, then in most cases, that's going to preempt the state laws, meaning that if you're complying with the federal law, then you're not going to have to follow the state law.
So I have not heard of federal exemptions before, Nick. I want to double tap into this. So what does it take to get a federal exemption from filing on a syndication or a capital raise?
So there's the main ones that I deal with is Regulation D. That's one that works very well for real estate. So Regulation D is a federal exemption that essentially says if you have all accredited investors, so people that have a high net worth or high income, so typically $200,000 for an individual is their income, or a net worth of $1 million excluding their primary residence. So that's somebody who's accredited. So if you have an accredited investor and only accredited investors, then you can raise an unlimited amount of capital from an unlimited number of investors, and you can solicit, so you can advertise your deal. But again, all of your investors must meet that accredited investor status definition. In contrast, you might say, look, I've got some people, some friends, some family that want to invest in my deal as well. And maybe some of them are accredited, but not all of them are accredited. A subpart of Regulation D would also allow you to have an unlimited number of accredited investors again, plus up to 35 sophisticated investors. So sophisticated essentially means they're financially savvy. They can, look at the documents and determine, does this make sense for me and my specific financial situation? Yeah. So you can have an unlimited number of accredited plus 35 unaccredited but sophisticated investors. But with that one, all of your investors, you must have a pre-existing substantial relationship, meaning that you knew them before the deal was on the table, and you essentially know if they're accredited or sophisticated and the reasons why. So those are our two, both of those fall under Regulation D, and Regulation D is a federal exemption, and those are two exemptions that I use very heavily for real estate clients. Part of the reason for that is that essentially you can get up and running and raising capital as quickly as we get everything together for you. Whereas other exemptions, you might have to send documents to the SEC or other government entities, and they've got to, check boxes or something like that before you can start. So Reg D is great because you can essentially start raising as quickly as you get all your stuff together.
So is there a difference between what you're talking about and a 506B or a 506C that we more commonly hear about?
That's exactly what I was discussing.
Okay, same thing. Okay, got it. It started to sound very familiar when you started to talk about the amount of accredited and sophisticated in there. Got it. All right, cool.
And
sorry.
When you started, I was like, I bet he has heard of federal exemption.
Yeah. I just hadn't heard it referred to like that.
Yeah. So Regulation D includes 506B and 506C. All of those are federal exemptions.
Excellent. Got it.
So we've done, we've done a mixed raise where we had accredited and sophisticated investors, and I think that can be a very, if I'm starting out trying to do my first capital raise, that can always be a very attractive way to go, depending on what my network looks like, because I might not know a ton of high net worth individuals or people that would qualify as accredited investors, but I'm very eager to get my first deal done and raise capital and get it to the finish line. I would say that we probably would never do a raise like that now. I don't know. We would do that again. I think it comes with a lot of extra legwork, not being able to reach a broader audience of accredited investors. Once you build that network, that's definitely the way to go. How do you define, though, when we're talking about sophisticated investors, right? That's where the definitions tend to become a little bit more murky, and I see why you're smiling, right? Like, how do people in your experience do they define the sophisticated investor status when they're trying to raise money from, say, friends and family for their first deal? How does all that work?
Yeah, that definition is one of the things that keeps me in business because it's very unclear.
There you go.
So yeah, as I said, we're trying to see, are they financially savvy? Can they determine the merits and risks of this deal and see whether it makes sense for themselves or not? One way that they can also be sophisticated is through the help of a financial planner. So if they have a financial planner or a financial advisor, that person can be reviewing the merits and risks, and that would satisfy as sophistication as well. Yeah. Some of the things that we look at, though, we look at their education. If they were a finance major, that might mean that they're sophisticated. Yeah. We look at what type of work they do. Are they working in some sort of financial industry type of job? That might make it. We also look at, have you served on boards of organizations? What are your current investments or past investments? If you've only done, stocks and bonds, the more traditional type of stuff, and you don't have a financial background at all, then you might not be sophisticated. Whereas maybe you don't have a financial background, but you invested in multiple syndications and you do lots of alternative asset investments, then that might say that you are sophisticated and have the ability to determine whether this makes sense for you or not. Because that's really what the SEC is looking for at the end of the day. They want to make sure these are people who don't have high net worth or high income. So if this deal goes bad, it's going to be much more painful for them. And so the SEC wants to make sure that they're at least going into this deal with their eyes wide open and understanding what these risks are and understanding that, yeah, I could lose my money. This might not work out how I want it to be. And in light of that, do I still want to move forward with this or not?
And that's, I appreciate the definition or the explanation, and that's why it's so important as a syndicator to work with a great securities attorney. When we did that, our raise that involved sophisticated investors, our attorneys put together. If you were accredited, you checked the box and you checked how you were accredited. And if you were sophisticated, you had a long questionnaire to fill out that was basically, here is your answer to why you qualify as a sophisticated investor. The syndicator's job should not be to come up with those questionnaires. Lean on your attorneys who are well-versed in doing these things to make sure that you're thoroughly vetting your sophisticated investors. At the end of the day, you're a fiduciary and a steward of their investment. You want to make sure that you're being entirely transparent and giving them the opportunity to be entirely as truthful and transparent as possible as to why they're sophisticated as well. This is a major investment on their part.
But I think too, one of the most important things before we even get to the securities filing piece of it is as a sponsor, knowing your investor pool. Yeah. Right. You got to talk to these folks first. You have to have a pre-existing relationship with them, right? And then B, how much can they afford? What was their last investment? Where are their investments? Like, I would assume, I don't want to assume, I'm going to ask Nick in a second, right? Like, if you have someone who's early in career, late 20s, early 30s, and they've really only invested in their 401k at work, right? Is that are they a sophisticated investor or not?
Probably not. Okay. Yeah, because that's just a very standard type of investment. And if they're doing that and they're, working in the financial industry, then maybe. But if they have a job that's not related at all to finances or anything like that, then yeah, that alone probably would not be. But again, one thing that they could do is, even if they themselves are not, if they have a financial planner or a financial advisor, then they can forward that deal to that person and they can rely on their financial savviness to show that they're sophisticated.
All right. Now, here's the opposite end of that question. Let's say, hypothetically, you're a blogger or you're very active on the internet and you go onto Reddit's page and you start hyping up GameStop. Does that make you sophisticated?
In many definitions, I would say no. Not only the security one, but other definitions as well.
Okay. We don't want any GameStoppers.
Yeah, right. I mean, so when we talk about this sophisticated, I always believe, and I think that you would concur, is, when it comes to all of these things are in place just to make sure, this is what the SEC is looking for, to make sure that we are investing responsibly, right? And that people aren't being taken advantage of. And so a lot of the onus also falls on the sponsors themselves to make sure that you are being as thorough with your offering in the way in which it's presented as you possibly can be, right? And I think that's one of the things that we did very well on the only sort of raise that we've done that involves sophisticated investors is, it was a lot more than just the investor webinar. We invited people into one-on-one calls to personally review the underwriting and all the data behind it, how we came to our assumptions and conclusions. And I mean, we went as far as to explain, what the underwriting even was. We're talking about people that had never invested in a multifamily deal before. They've invested in a lot of other things, but explaining the terminology, explaining our forecasting, explaining, our P&L predictions and things like that. You really want to make sure as a sponsor, in all regards, that you are always being as informative as possible on your deals before you're taking people's money.
Yeah.
I mean, plain and simple. What other things do you see from sponsors that they kind of go, I would say, even more above and beyond to be educational when they're dealing with sophisticated raisers?
Yeah, you hit on some great things to do, having the webinar initially to just generally tell things and then kind of explaining stuff to them. I'm going to say I think this, but also I believe statistics would show this as well, that people don't sue people that they like typically. They also don't sue people when they are informed. And so giving that type of information, going through, showing your assumptions that you made, explaining how you arrived at certain projections and things like that, that's going to make the investor informed. So now that if something goes wrong, they're not going to think, oh, they're being shady or they're trying to pull the wool over my eyes. They're going to say, oh, yeah, I understood. They explained why the assumption made sense to them at the time. But now I can see, interest rates have shot up or something like that. So now it makes sense as to why those assumptions are not being carried out in real life and not becoming true. So yeah, the communication and that clarity and being available to answer questions, that's something that's very important for sure as an operator and issuer of the security.
Now, from an attorney's point of view, so I think there's two things on my mind. Number one is what do you consider the right level of communication from a sponsor to their investors about the status of a project?
I typically tell my clients more communication is better. Kind of just going back to what I was just talking about. I typically recommend at least quarterly. So every quarter, and if you don't have a whole lot to share, just every quarter have that regular quarterly meeting that your investors are going to be looking out for, trying to get whatever updates you might have. And even sometimes the update might be no updates. A couple reasons why I recommend quarterly or at least very regularly. As I said before, communication, I think, is very important. If you're communicating with somebody or communicating with an investor, if things go wrong, they're going to be less likely to think, oh, they're doing bad things or they're stealing my money, because you told them what's happening. And so they likely could predict some of those things that might have gone wrong because you're keeping them up to date with what's going on with the asset. So that's one thing that makes it helpful. Another thing that doing those regular meetings helps you with is that if you're doing regular meetings, your investors are expecting that. And so they're knowing, every quarter we're going to have this meeting. They're going to give me an update. And so if there is bad information, if there is something bad going on with the property, that happens. We can't have a perfect deal and we can't control everything. So bad things are going to happen. So if there is something bad and some bad information that you need to tell them, it's going to seem a lot worse if they haven't heard from you for 6 months or 9 months and they don't hear from you regularly. It's going to be like, oh my goodness, this is so bad that he had to have a special meeting and get everybody on board and tell them, versus if you have your regular quarterly meeting, they're like, yep, here's another meeting. Oh, okay, maybe the information at this one wasn't quite as great, but he's always giving us information. And we always have these quarterly meetings. So I'm not overtly alarmed by this thing that's negative on the property because I'm always getting communication from this operator anyway. So having the communication can go very far in both avoiding lawsuits, keeping investors happy, and just really helping yourself and not having to deal with a lot of investor relation issues as well.
Nice.
I mean, I couldn't have said that from the others, being someone that experiences, this is an LP. I'm in several deals right now, and they're not all going well as an LP, right? Some of them were done in the last couple of years, and we've had rate caps on them, but nobody thought that we would hit those caps, and it's definitely stifled cash flow when you talk about the increases in insurance and taxes and things like that. And I have one deal that's probably performing the worst out of a few of them, but I get very regular communication, and I would 100% and will 100% invest with those sponsors again. I see the communication. I see what they are doing to right the ship a little bit. This is a long-term hold. It's not gonna be something that goes sideways overnight. It's not gonna be something that gets on track overnight, but they're headed in the right direction. I see their efforts, and they are very communicative. I have another deal that is probably performing better, but I don't know that I would ever invest with that sponsor again.
Really?
Because the communication has been so sporadic. And when it does come through, it's not nearly as thorough as what I am used to, that it almost feels forced.
Really?
You know what I mean? And that becomes a big turnoff. The only reason I know more about that deal is because I through relationships, I know a little bit more about what's going on with it. But if I was just a regular LP that didn't know the sponsors personally, I don't know that I would invest with them.
Really?
Yeah.
So when you say sporadic communication, what does that actually mean?
I have probably been updated on the deal that I am referring to that I'm not crazy about. That deal is about 1.5 years old. I think I've got 3 updates.
Whoa.
Yeah.
We've sent that more on BC in the last 6 months.
I mean, quarterly is I think plenty. I get monthly updates on the first one I was talking about, and I don't think that deal is performing nearly as well as the one that I'm a little annoyed about. But they do, not only do they do, monthly updates, they send the entire financial package out of Resman. You can see, how negative we were in the beginning, and now we're trending in the right direction. That's where I think sponsors get really hesitant to do things like that, is like, you're building up the opportunity of this investment. Right. And then you get very afraid to send out a P&L that has anything red on it. And if you just are honest about that, especially in the craziest of times like we're facing right now, anybody who's investing with a level head and not going to get emotional about it, they're not going to judge you for the red on the P&L as long as you're moving in the right direction and you're taking action. Right. You know what I mean? We've been in the red on that deal for a while. We're riding the ship. And like I said, it's a 5-year hold. We're going to be just fine. I'm very, very impressed with their performance, what they've done to overcome obstacles that nobody was predicting we would be facing. And so I've actually become more impressed with these sponsors through this time, because I know as a GP myself what they're up against, and I very much respect their level of communication. Whereas getting very sporadic communication about a deal that's actually doing better doesn't make me feel good about how that sponsor operates.
Got it. Nice. Thanks for sharing that. That's awesome. And so, Nic, before the show, we were chatting a little bit about, actually a perfect segue. So there was something I saw on Facebook today, which, by the way, automatically makes it true. But it was an article about some of the gurus, right? And how some of the gurus were out there in the marketplace making millionaires and dancing and all kinds of crazy stuff. And now they're starting to see signs that the foundation's cracking, right? Yeah. And there were some gurus named in there. And I won't say which ones they were, but there's got to be some sort of backlash, right, in the investor community about deals that perhaps weren't performing as well as expected or as well as positioned, or everybody just kind of just got on the multifamily gravy train. So, Nic, from a legal perspective, like, what are you seeing after the raise is complete and the equities put to work and the deal is being repositioned? So, how are you hearing about some of these deals on the flip side?
So yeah, if the deals that aren't going so well, it becomes a problem. And kind of as you were talking about the better communication, those operators tend to maybe fare okay. But the deals that aren't going well, that aren't getting communication and that are having issues, those operators' issues are going to compound. A lot of times a lot of operators are like, I'm afraid the SEC, they're going to put me in jail. They're going to do all this stuff. And I say, look, yes, it's good to have a moderate fear of that, not an overtaking fear, but have a fear of that because that's going to make you ensure that you're doing things correctly and crossing your T's and dotting your I's. But the SEC in most cases is not knocking on doors saying, show me your PPM, show me this, show me that. Mm-hmm. Instead, what happens is there's a complaint. There's an investor that's upset, or maybe an employee that's upset. And that's what gets the company on the SEC's radar. And then they start diving into things. And so, as we know, kind of the market's very different now than it was even just 2 years ago. And definitely for the past, 5 to 8 years, the market was really good. And so these gurus, they may not have been very good at themselves at all, but the market was going to make any deal look great and make anybody that was doing it 5 years ago, you're going to look like a rock star. Well, now we're seeing that, the market's not going to save you. You've got to actually have skill and get into a good deal and be able to operate well. Otherwise, the deals are going to be a lot harder to make a return on. And so with that, as we start seeing investors, unfortunately, start losing money and missing out on distribution and things like that, that's when you're going to start getting more complaints. And then that's when the SEC is going to get a lot of these companies under their radar, and they're going to start digging and trying to see what's going on. What did you disclose? Did you file things properly, and all that kind of stuff?
Ooh. I mean, 100%. Again, it comes back to communication for sure. Are you starting to see those things manifest themselves? And so, I mean, all over the news, we do get the big stories of, the massive syndicators that lost 4,000 units to foreclosures and things like that, right? Are you seeing, even on a smaller scale, are you starting to see investor backlash from lack of communication from syndicators and sponsors actually starting to really take root and have some consequences for syndicators that weren't really doing things on the up and up?
So personally with my clients, thankfully, haven't seen actual consequences, but definitely have heard many stories about some issues that clients or that operators are having. And if I were a betting man, I'd say we're going to be hearing a lot more of those types of stories as well. One thing that was interesting when we may be talking about a different issue, but there was a big portfolio I believe it was in Texas, that had to foreclose, and their investors just got really screwed over. And that spilled over into my clients that are the operators, in the sense that my clients' investors now were getting scared and saying, what's going on? What was that? What was happening there? And I think there's a Wall Street Journal out there as well that kind of talked about how a lot of people were jumping into syndication and not really having the skill, and were relying on the market to save them. And now that's not happening. And so that backlash that had nothing to do with my client actually was making it harder for my client to raise capital, because investors were seeing that and kind of start taking a pause or getting a little bit afraid there.
Yeah, 100%. It becomes kind of a contagion of anxiety around your deals. And so even the great sponsors have a lot of clients that are probably asking questions right now. And I think that gets to the heart of the matter. If I am a sponsor and I am looking to start raising capital for my next deal, and I need a great securities attorney, aside from just calling you, right? What am I looking for to make sure that my legal team is doing things the right way? And I'm not only protecting myself as a sponsor, but I'm being a great steward of my investors.
Yeah. So, working with an attorney, it really is.
Oh, no.
Okay. Should we freeze too?
We should do it like that.
Wait till he comes back and we'll be like,
and then we'll all move again. Okay, we'll edit this out. I always think about when people freeze, like what it could be, meaning like it definitely could just be his internet connection, or somebody could just walked in his room and just ripped all his cords out from behind his computer, and now they're like, now he's in a big fight with this person. Like,
you spend too much time playing video games. Now you can't do anything.
Exactly. He's like rolling around on the ground, beating this guy up. Oh no. Okay, let's shoot him an email, I guess, and
we'll come back.
Oh, he's got the link. That's right. Okay. Well, smoke break. Is that Duncan?
He sounds like somebody, can't figure out who. Dude, there was some weird stuff happening at the very beginning of you talking. I'll make sure that it's not like that in post. I don't think it is.
Okay.
But because it usually isn't. But there were some weird things happening, like with your voice. I was just
With what was it doing?
just at one point it pulled the bass out.
Oh, really?
Yeah.
Huh.
So it was really strange.
Dude, Michael Trithard hit you up?
Yeah.
He's big.
Yeah, that's what Nick he texted about.
Oh, dude. Oh, yeah. Okay.
Yeah. There he is.
Hey, he's back.
Of course, it happens at an opportune time.
That's
No
right. Worries. We can edit all that out, dude.
We tried to stay frozen until you came back, but I had to breathe.
I heard you talking. You're like, I heard, should we freeze too?
Oh man, that's funny. Okay, dude, we can take it right from where my question was, just diving in around, how to select a great attorney and making sure that you're being buttoned up. Basically, just we'll cut that from where I asked the question, and it'll just go right into your answer.
Okay.
Yeah. Whenever you're ready.
Yeah, so working with an attorney, you want to have a good relationship with them. They're going to be somebody that you're talking with very regularly and you're confiding in. And so first thing I'd say is you want to make sure that you just feel comfortable working with them overall, because you're going to have to interact with them a lot.
Yeah.
Another thing you want to look for is how candid are they being with you? You want an attorney that makes you feel good in some way. I get that, but you don't want an attorney that makes you feel good at the risk of giving you the candid, truthful information. So you want somebody that's going to be telling you the bad stuff or saying, hey, this needs to change or you can't do this, even though it's not necessarily what you want. You also are going to just want their experience. Do they understand this world? Because as we've been talking, and as I'm sure you know, this is very, very, very nuanced. And in law, even, we say that we practice law. And people always laugh at me. I'm like, we really are. What we're doing is we're trying things out. And we're like, yeah, that one works. Cool. Let's keep doing that. And then sometimes we'll try it out and we're like, yeah, that one didn't quite work. Now, we're not just randomly throwing darts saying we hope it'll work. We've got, case law and statutes and things that are guiding us, that are helping us determine, yeah, I think this is going to work. But even, if we get to when we were talking earlier about the definition of sophisticated investor, it's not very clear. So you're going to want somebody that has dealt with that, and they say, hey, look, I've had clients do this. I've had clients that have had the SEC looking at what's going on, and we did this process and it worked and it was fine and the SEC had no problem. So you're going to want somebody that has experience, because while there are laws and rules, as we know, the laws and rules are not directly going to give us our answer. And so instead, you want somebody who has gone through these things and has seen multiple iterations, so they can guide you based upon what the law says and the best practices that they've seen that have worked out well also.
Nice. So we had a couple of attorneys on, I don't know, 4 or 5 weeks ago now. And, we've worked with these folks before. They're here local in North Texas, great group. One of the things that we really appreciate about working with them is the fact that they handle the securities portion of the deal and the real estate portion of the deal in the same office, right? And I had a number of syndication attorneys referred to us, or securities attorneys referred to us, a year and a half ago. And as I would meet with them and just kind of get to know them, they were only handling the security side. So anything regarding real estate law and surveys and all other kinds of stuff, I would have to go find a second attorney. So do you, Nick, in your practice, do you handle both sides of the transaction?
So yes, we do handle the actual real estate transaction itself. What I do, the caveat that I do give with that though, is that if it's us running it, we only do that in California and Washington where we're licensed, just because it is very state specific. But sometimes what we'll do is, if a client is in a different state, then we might either help them find an attorney, or we also have some attorneys that we kind of partner with. So we'll run it through us, but that attorney is handling the state specific stuff and we're communicating with them very well. There are other times where the client might have their own local attorney, in which case we say, look, we'll do the security stuff. And if you need our help, we can, be the referee and kind of liaise between the lender or the seller or whoever else and your transactional attorney, or also just work with you and the transactional attorney. So while we do handle both sides, the transaction and the securities, in most situations, a lot of our clients are not acquiring stuff, and not many in California at all, a handful in Washington. So if they're in states that we don't operate in, then we do refer that out, or we have some preferred providers that we work with and handle it together.
Yeah. Thanks for that. I want to dig in, if you don't mind, to California from an investing perspective. So, I work for RealPage. We have a number of customers out in California, and I have a number of folks in my network that invest and own properties out there. And some of the stories that they tell me about certain counties barring utility reimbursement and capping rent growth and all kinds, eviction moratoriums and stuff, lead me to believe that that is a very difficult environment to invest in and profit in, right? Quite frankly. What are you hearing? What are you seeing, boots on the ground in the California market?
Yeah, you summed it up pretty well. I always tell people, I say, look, California is a great market to invest in when you have a lot of money. If you're trying to preserve it and grow it slow, your property, we never know that's always going to go up. But California real estate, even in the 2009 recession, there were many neighborhoods in California where they were having multiple bids and properties being sold above what the asking price was. So for long-term preservation and slow growth, California is great for that. But if you're, not quite where you want to be financially and you're trying to grow, California is going to be a lot harder. Part of it just is the acquisition cost. The cost to get in the asset is going to be far more. There's probably many situations where, your earnest money deposit to buy an asset in California could almost outright buy that similar asset in a different market. So wow. The cost of acquisition, the cost to get in is very high, and the returns are going to be a bit smaller because of that. And so, yeah, it's a good market when you've got kind of the money you want and you want to grow it slowly and preserve it. It's great for that. But if you're trying to grow fast and get up to the level you want to, it is going to take you quite a bit of time if you start in California versus going into other markets that have much lower barriers of entry. And yeah, you mentioned on that California is very, very, very tenant friendly. And so, if your plan is let's go value add and kick everybody out and renovate it all, in many places in California, you're not going to be able to do that. Or if you are, it's going to be very costly because you're going to have to pay the renters to relocate them in a lot of situations.
Cash for keys type.
Yeah.
Yeah. Interesting. I kind of thought that was the case because, Vanessa makes me watch like Selling the OC and Real Housewives of all kinds. There's no Selling Multifamily in LA TV show yet.
No, there's not. That's hysterical. What markets are you seeing that are quite a bit more active right now that you guys are working in and doing deals in? I'm not sure what the active one is now. You've had asked me like 4 years ago, I would have said, Dallas and Houston, and I'm still seeing stuff going on there. If you had asked me probably a year or two ago, I would have said the Carolinas. A year or two ago, I was doing a whole bunch in North and South Carolina. Yeah. Now I'm getting a bit more in Georgia, but also seeing the Carolinas, and Florida's another hot market. Dallas or Texas as well. So kind of all of those, I'm seeing a mix. No, at least in my anecdotal small experience, I'm not seeing one of them stand out. But yeah, in the past, I would have said Dallas and Houston. Then it moved to the Carolinas, and now it's kind of a mixture of all those different markets, at least from what I'm seeing. Yeah, southeast. Region.
Yeah,
that makes a lot of sense. I think we're kind of seeing the same thing.
Yeah.
As far as this is the hot topic to just talk about right now, how things have changed over the last couple of years and where they're headed and things like that. You work obviously very closely with a lot of syndicators and people that you serve. What is your particular take on the next 24 months of activity and the market rates, all that type of stuff? We love hearing everybody's philosophy, with the craziness and variables that have been presented over the last couple of years. Where do you think that we're headed?
Yeah, I think that unfortunately there are going to be a lot of investors and operators that don't fare so well. But with that's going to create a lot of opportunity, I think. And I've actually even had clients that are already getting kind of offers. They have, their colleagues that are operators saying, hey, we're in trouble. Like, can you help us out here? Is there, what can we do to kind of get out of this with the least bit of pain? And so I'm already getting clients that are not quite getting fire sales, but approaching that. And I think as we go, I think even probably in the next 12 months, we'll start seeing that, because I'm not even going to throw out the number, but I read an article about a month or two ago, and I can't remember, but there's a pretty high number in the thousands of multifamily assets whose rate locks were going to expire or their loans were expiring. A lot of people, at least my clients, typically they were getting in and still are getting, loans for anywhere from 3 to maybe 7 years. And again, the market's been hot for, since 2015, 2013. And so those loans are starting to expire, and those loans were at 2%. And now they're going to be trying to get another loan at, 7% or 8% or something like that. So that's going to cause a lot of problems. And so the interest rates and the loans and that sort of stuff, I think, is going to cause a lot of problems for people. But with that, that creates some opportunities for others as well.
Yeah, we're hearing pretty much the exact same story, right? As a matter of fact, we threw an offer in on a deal 3 weeks ago that they had purchased floating rate, a variable rate debt, floating rate debt, right? They bought a rate cap. They're 2 years in their hold. They bought a 3-year rate cap, so they got a year left. But they already need to start escrowing for the next rate cap, which is coming due in a year. And they were like standing their ground on the purchase price, or the sales price, I should say, excuse me. And we did the math, and I don't know how they're going to be cash flow solvent with this enormous escrow, because the amount of the rate cap went up by 20x, not 20,000, from $28,000 to $560,000 for the same rate cap.
Wow.
And I just don't know how they're going to survive.
Yeah.
And we're ready to take the deal, by the way. And if you're listening, we're still ready to take the deal.
We know who you are.
Yeah. But I just don't know. Are they just going to wait till the last minute and say, we changed our mind, fire sale it, when they could have probably gotten better terms from us now?
Yeah.
There's something about that psychology, this is if you compare it to the single family era of the Great Recession, how many people held on to homes that they probably didn't need to go into foreclosure. It's that human nature.
Yeah, it's like when people were buying, even up here, when I first moved here, I knew people that were buying homes intentionally losing money on the mortgage, right? Just to say they owned a second home or a rental house, thinking that they were going to, make it big on the equity side. And whoops, bet you would have sold a year ago.
Yeah.
Right.
100%, man. 100%.
Yeah, kind of in a slightly different industry. I have a client, we help them raise capital for a restaurant, and then we handle some of their just general restaurant stuff. And so they were trying to expand and go into a new location. And the location had, all the restaurant fixtures and all that stuff, like probably $500,000 worth of stuff, if not more. And our client offered them a good amount of money. And the people were like, no, you got to have more. You got to get more. And our client didn't want to do it. Fast forward, we didn't realize they were in as much trouble as they were. But fast forward, like 6 months later, the seller, so to speak, was not paying their rent. And so the landlord overtook all of those restaurant fixtures. And they let our client walk in. They're like, yeah, if you want the lease, take all the equipment with it. And so our client ended up saving like $2 million or something like that, because they're going to buy the whole restaurant, the IP, all that. But our client had a restaurant and IP. So they just said, look, we're going to just make another location of our restaurant. And now we have all this free equipment because they didn't want to sell it to us. So when you're talking, that kind of reminded me, it's like you can sell right now and get something, or you can wait till things are really bad, and then you're going to lose out on dramatically more.
Mm-hmm.
That is such a great just image, visual, and such that is how people get. And I think a lot of it is, and look, we never want people to lose money or deals or anything like that. We're not hoping that those things happen. If we all had it our way, the market would always point north. Right. It's also true that that's not always the case. And I personally see we have this game of chicken going on. I believe it for a lot of these deals, that especially with rate cap premiums being their kind of pain point that is really siphoning off all their cash flow. We were talking to a broker the other day, and he made the point of like, well, yeah, but it's all based on trajectory. The first time that the Fed cuts rates, those rate caps are going to go down 20x, which is probably true. And What if they don't?
Right.
Right?
Yeah.
What if they don't cut rates until 2025? What if they don't go down 20x the way that we think that they will? But there are a lot of syndicators out there that are their deals are bleeding right now, and it will only take one correct move from the Fed to shift that momentum. What if that never comes?
Yeah.
Or what if it doesn't come in time? And are you willing to be that committed to your business plan that you're just getting in this Mexican standoff basically with the federal government, hoping that that deal can last long enough for them to do something that's in your favor, whether or not they are motivated to in any way, shape, or form.
Right. Yeah, I think now's the right time where you can't let pride or ego get in the way, right? If you're in a deal that is underperforming and maybe you don't see the light of day, what happens if you just got your equity back, licked your wounds, right, and then reevaluated and underwrote a new opportunity using today's variables and criteria? Could you ultimately make your returns off that deal? And I think those are honest questions that there's a lot of people out there asking themselves. I mean, we're starting to hear about them. We're in those conversations. I don't want to see anybody get hurt. It's just bad for the entire business,
Sure,
right? For the entire industry. It's a small industry. But in the event, something's going wrong, I think there's good operators like us that could step in and really, deliver returns for our investors.
We have this conversation around the difference between return of capital, return on capital.
Yeah,
Right now,
exactly.
a lot of people need to be in return of capital mode. And it goes back to exactly what Nick was saying before, where when it comes to communication. If you had told me, 3 years ago, let's just say, that we were going to get into a deal that the only way that deal was going to go sideways is if something crazy happened, like
Property taxes got assessed at the full valuation.
yeah, let's just say property taxes, increased substantially. Insurance maybe doubled over that period of time. A war broke out in Europe for the first time in 80 years, and the federal government decided to hike rates at the fastest rate in human history. If all of those things happened, right, then I would at least get my money back.
Mm-hmm.
If you said that and then got me my return of capital, I am 100% investing with you again, right? If you saw those things happening and held on so long, even though the deal wasn't performing, that you lost my money, I'm going to feel like you had the writing was on the wall to try and liquidate and dispo early and just get the money back, or at least most of the money back. And that's where I think syndicators come from, a place of your response. They forget that the first rule and responsibility of being a fiduciary is not to lose people's money.
Right.
Right. And you can't violate that first rule. If you have the ability not to, then you have that responsibility not to,
Agreed.
even if you're not going to get the returns that you advertised.
Right. Yep. Exactly.
Yeah.
All right, we're coming up on time here, Nick. Before we ask final questions, if you're, aside from the communication, which I think we covered a lot, do you have any advice or golden nuggets that the folks in the multifamily community should be taking forward, from a legal or securities law perspective right now?
Yeah, and this is probably even more of just a practical thing. We're talking about how, the market has changed dramatically and, we got to do things differently. And so with that, you do have to do things differently. I have some clients that have been in this and they're doing well, and they've been in it for, 5-10 years. And now they're saying, yeah, but this is what we always did. And I said, that's great, but we're not how we always used to be. So because things are changing, how we operate and how we do things, that's going to need to change as well to reflect the current situation that we're in.
Yeah, love it.
Agreed.
All right, Nick, let's say one of our listeners is out there looking for a top legal securities attorney, a guy who plays the alto sax and maybe can do some card tricks during webinars and stuff. How do they get in touch with you?
Yeah, so the easiest way is on social media. I'm at Nic the Lawyer. That's NIC the Lawyer. If you go to like Instagram or TikTok, click on the link in bio and you'll have all the ways to contact us. Or also go to our website, polymathlegal.com. That's POLYMATHLEGAL.com. Again, on there has the phone number. You can message us directly and also schedule a free 15-minute discovery call to see if we offer the types of services that you're looking for and learn more about our processes and pricing as well.
Love that.
Love it.
Absolutely, man. Nic,
Cool.
thank you so much for the time, man. We really, really appreciate the conversation. We'll have to do it again.
Yes, thank you so much for having me. Love it. And I'm happy to come back whenever you want me to.
Nice.
Absolutely, guys. Find Nic on social media. And what was that? Polymathlegal.com?
Correct.
All right. Make sure you check out Deep Blue RE as well, the home of Deep Blue Capital, and Tor Studios, TORE studios.com as well. Nic, we really appreciate it. Boys, another one of the
Another great one. Love it.
Great one.
Cool.
Appreciate it. All right,
Thanks,
guys.
brother.
We'll see y'all next week.
Thanks, everybody.